Credit score is a phrase you might occasionally think about, maybe you worry about it, but do you understand it? Today, I'm going to take you through what a credit score actually is and, more importantly, how it is different to your credit report. So, let's start at the start. What is a credit score? So, a credit score is a score you're given based on information in your credit report. It's basically a number that reflects how good or bad your credit report is. The higher it is, the healthier your finances are looking. Now, there are three credit reference agencies in the UK: Experian, Equifax, and TransUnion, which I will explain a bit more about later. And each of these will give you a different score. So, for example, your Experian score will be out of 999, whereas your Equifax score will be out of 1,000, and TransUnion's is weirdly out of 710. The average score in the UK is 640, according to Equifax, but obviously it will differ depending on which score you're looking at. And another thing to know is that only you see this credit score, no one else. Now, a credit report is not the same thing, even though the terms are often used interchangeably. The report, though, is what really counts, and it's pretty much a record of your financial history. So, any account you've applied for that requires a credit check, things like credit cards, mortgages, loans, mobile phone contracts, bank accounts, and more, will be on there along with money that you owe on each of these. Plus, it will show you how long you've had the account, your payment history, including missed and late payments, as well as bankruptcy, county court judgments, and any debt solutions that you've opted for. It also shows your address history plus any financial connections that you have. So that could be joint accounts and joint mortgages. The reason your credit report is important, as it's one of the things lenders will look at when deciding to offer you products. So they'll use it to work out how reliable you are and whether you can afford the borrowing, as well as how likely they are to make money from you. It can also impact how much you will be offered to borrow and the length of the deal. So, for example, with 0% credit cards, you might be offered 12 months or 24 months, for example, depending on your credit report. It will also impact the rate that they offer you. So, the better your credit score, the lower the rate. A credit report is also used to verify your ID. When you make an application for, say, a loan or a credit card, you'll probably hear the words credit check or credit search banded about quite a lot. It's literally the lender checking and searching your report. Now, there are two types of search, and it's really important to know the difference between each. The first is a hard search, and it will be made when you make most types of full application. Now, this type of search appears on your report for other lenders to see whether you're successful or not, and will remain on your report for a year in most cases. And each hard search will likely reduce your credit score in the short term. Now, soft checks are different. These are often used when the provider only wants to check your ID or there's no actual borrowing involved. If you use a comparison site to assess your eligibility before applying for a credit card, they'll only do a soft check too. Now, importantly, you'll be able to see them on your file, but lenders can't, and they won't impact your score at all. This distinction between these two types of searches can be really important, especially to reduce the chances you'll get rejected for credit. So the question is, do credit scores matter? It's not an easy answer, and it's basically yes and no. So, though the score reflects your financial history, lenders will still be adding in extra information that they have on you to decide whether to lend to you or not. You'll have to put information down on the application form, and if you're an existing customer, they might have their own file on you anyway. Some lenders are also using open banking, and this suggests that they might be able to see when you've taken a payment holiday on a mortgage or other types of borrowing, which they could factor in before deciding to offer you credit. So, what this means is that your score won't reflect everything that the lender is taking into account, and different lenders will consider different things. So, even if you've got a really good credit score, you might still be rejected, or you could be accepted even if you've got an average score. Saying that, credit scores aren't pointless. They're still useful indicators of how healthy your credit report is. As I mentioned before, the higher your credit score, the more likely it is you'll get accepted for credit cards, mortgages, and loans, or get a better deal, such as lower interest rates. And again, with a low score, which indicates a bad credit report, it could mean you get rejected or offer less money than you need, or at a higher rate. So keep an eye on your score. Keeping on top of it will help you decide whether you need to do anything to improve your report in the meantime. And when those actions make a difference, you'll see that reflected in an increased score, telling you that you're on the right path. Now, I want to quickly explain a bit about credit reference agencies. As I said earlier, in the UK, there are three: Experian, Equifax, and TransUnion. And these are the companies lenders go to for your financial history. Each will have slightly different information on you in your credit report and will work out your score slightly differently from the other. They even have completely different scales, making it hard to compare one with the other. It's worth noting that when you apply for credit, you don't know which of the three credit reference companies will be used, which basically means all three credit reports are as important as each other. So you can check all three scores and reports using different websites for free. So Equifax, you can use ClearScore. TransUnion, you can go via Credit Karma. And with Experian, they've got something called Credit Expert. Now, with this one, you can get a 30-day free trial, but do cancel before the end of that trial to avoid the $14.99 a month fee. You can also sign up for Experian's free statutory credit report, which you've got a legal right to, but it is a lot more basic. It's also worth checking if you can get cash back when you sign up for your credit report via cashback sites. So, to sum it up, do keep an eye on your credit score, especially if you know you're going to be making an application for a loan, credit card, or mortgage, or anywhere you know your report is going to be checked. If you know this is coming up, check for any errors or potential problems before applying. Even if you're not planning to borrow anytime soon, it's also worth looking at least once a year, if not more often, just to make sure there's nothing fraudulent going on. And that's it. Thanks so much for watching. Check out these videos here for more ways to make the most of your money.